Trading versus investing, which is better for you? Stock trading has always been a popular pastime, but it has grown in popularity during the 2010s protracted bull market. However, its popularity surged during the 2020 coronavirus outbreak. Nowadays, there are several well-known businesses. You may know someone who has started trading instead of merely contributing to a 401k or purchasing mutual funds occasionally, and you're pondering whether you should do the same. But remember that the phrase active investor is an oxymoron. Hello everyone and welcome to another video on our channel. In today's video, we're going to discuss trading versus investing, which is better for you. So stay tuned to find out. Let's start our video. The most frequent investments are financial assets, stocks, bonds, mutual or exchange-traded funds, and so on. Investors often view their assets in the long term and want to accumulate wealth largely via long-term appreciation and compound interest. An investment's risk of financial loss rises as the time horizon shortens. If you need to withdraw money within 3 years, the Securities and Exchange Commission's or SEC Office of Investor Education and Advocacy recommends putting it in a savings account. Investing may be a much better option for accomplishing any other goals. Some investors may have long-term ambitions to continue with their present investments. Investors may decrease their exposure to any other market's volatility and lower their overall risk by spreading their money across various assets, rapid, violent, or unexpected changes in values or price. Mutual funds and exchange-traded funds, or ETFs, enable investors to diversify their portfolios instantaneously by acquiring a single financial vehicle that contains many assets. When selecting how to arrange your portfolio's assets, consider how comfortable you are with risk and when you intend to begin withdrawing money. Fundamental indicators or elements inherent in the issuing business and utilized by investors to choose stocks and bonds include the company's earnings, history, and creditworthiness. Using these factors, one may identify firms that are either underpriced in the case of value investing or have a high price rise potential. For example, growth investing. Trading principles. Trading is the quick buying and selling of stocks and other assets for profit. Traders are more concerned with shorter periods than investors are, weeks, days, or even minutes. Swing trading and day trading are two popular trading tactics. Day traders are investors who maintain positions for just one trading day. Swing traders, on the other hand, invest in assets that they believe will increase in value over a few days to a few weeks. In the financial markets, the fundamentals of a company's stock are unimportant. It's crucial to note that just because a stock's value is expected to improve over the next several years doesn't mean it will do so right now. As a result, traders increasingly rely on market news and technical analysis to guide their bets. If you're liking this content so far, please consider subscribing and like this video. Now let's continue. Trading is a risky business with the potential for significant loss. A big chunk of money might vanish swiftly if a trade goes wrong. Furthermore, traders often employ leverage, which means they take on greater risk by borrowing money or acquiring assets with cash that they don't already possess. Leverage may be used in several situations, such as options trading, margin trading, and short selling. There is a widespread belief that well-known traders are more knowledgeable and competent than their less famed competitors. While some investors are better at understanding charts and doing technical analysis, no one can reliably predict market moves. Even well-known investors may suffer big losses. If you want to start trading but are concerned about making a significant error, restricting your position size, the amount of money you put into each transaction, may be beneficial. Another piece of advice is to establish a stop-loss order that will be executed automatically if the asset goes below a certain price, thereby limiting your losses. Trading and investing involve financial markets and assets, but they serve different goals. As a result, broad generalizations are problematic. However, two major variables make trading riskier. It requires much guessing, intuition, and risk-taking. Given how time-consuming it is to maintain track of more than a few trades, this method asks for little or no diversity. Furthermore, the evens-out feature of diversity minimizes the effects of both ups and downs, and investors want the greatest possible peaks. Profits are another possible result of trading. Annual returns of 8 to 10% are a reasonable aim for many investors. On the other hand, a trader would expect to earn at least that much each month. The annual uncompounded return for a trader earning just 5% each month is 60%. As a result, declaring one strategy the best way to approach the stock market is difficult. Investing is the best solution if you have a low risk tolerance and want to minimize volatility. On the other hand, trading may be appealing if you're a risk taker who values the chance to earn large profits quickly. It is important to understand that trading and investing are not mutually exclusive activities. For example, you may put 90% of your money into a diversified portfolio that you want to keep for a long term, and the remaining 10% as play money for riskier short-term investments. Well, that's all for today's video. Tell us in the comments section how this video was. I hope that you found this one interesting. You can subscribe and watch more videos on our channel to keep up with more content. We'll see you in the following video with some more notable facts and stories. And until then, stay tuned.